CPI for beef and veal rose 1% year over year in May. I was getting a little excited. That might be the first deflationary category. That was much less than the overall CPI for food at home, which increased 5.8%. Everyday meat case prices, what you see in the grocery store was almost flat year over year. And I thought the meat department, was going to be that first deflationary category, but beef prices for consumers, they may rise at a faster rate in the future as seasonal demand increases with less supply available. So I just wanted to look into what was going on with beef, and it's not good. Many ranchers shrank their herd sizes last year due to the drought and the high cost of feed. Corn prices were quite high last year. And of course, the drought led to less grazing available for the cows. So the cow herd is now at the smallest size it's been since the early 1960s. And live cattle prices hit a record high earlier this month. And I brought along a chart, to rebuild the herd, more cattle will have to be removed from the market. And then feeder cattle prices that's what a rancher needs to try to rebuild it. Those prices are up 1/3 this year. That's about a record since November of 1971. So that's an indication that ranchers would like to rebuild it. They have the price signal, but they have to pay up for that. So I think beef, from here looks inflationary to me. And Howard and I have discussed the implication for the steakhouses, which isn't good. But there's a little bit of an effect of when the price is so high, people don't want to maybe burn it at home and decide to have the professionals do it. But besides that little effect, it's going to be quite inflationary.
Thanks, Keith. And I would just add to Daniel's comments, Shake Shack pointed that out. And I'm mentioning Shake Shack just because we're short Shake Shack and we did a deck last week, but they pointed out how inflationary beef prices is going to be for them this year. And we put a few slides in our deck. And on that point for Shake Shack, the mayor of San Francisco proposed remaking the city, struggling downtown by closing the Westfield Mall. And I believe the Westfield people said they're going to give it back to the city anyway, or the landlords. I point this out because Shake Shack has a store in that mall. They opened the store. This is, I think, their third store in San Francisco. They opened that store in 2021. So I made the point for a year that this aggressive growth strategy of Shake Shack leads to poor real estate decisions. So why the hell were they opening up a store in 2021 in a mall in San Francisco? They shouldn't have been, because they had no idea what they're doing. So I point that out because I firmly believe that this is going to be a great short, and it's based on poor real estate decisions. And here's a classic example of that.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.